We are witnessing a trade war, and although some of the toughest measures are on hold, tariffs on the UK remain unchanged. But what exactly does this mean, and how might the economic consequences of tariffs impact you and your household? You will have seen stock markets crashing around the world following Donald Trump's Liberation Day, where he announced a host of new tariffs around the world. Fluctuations in the market are nothing new, but seeing them happen on a large scale has historically had consequences for us all, even for those who are not big investors. For those who keep money in stocks and shares, volatile movements can be unnerving. Initial movements following the US president's announcement wiped billions of pounds off the world's biggest markets. That's fine, you might be thinking. I don't put money in stocks anyway. But it's not quite that simple. You may have a pension or savings, like an ISA. These financial products, although diversified and vested in other assets like government bonds, could mean your funds are worth less if markets tank. Millions of people around the country have a pensions pot, either privately or through work. Pension savers mostly let experts choose where to invest this money to help it grow. Widespread falls in share prices are likely to be bad news for pension savers. So big rises or falls can affect your pension. But the advice is to remember that pension savings, like any investments, are usually a long-term bet. Experts are urging people not to panic in such circumstances or make knee-jerk decisions. No one can ever be sure at this point how inflationary a global trade war might be, but experts have made some predictions, and it doesn't look good. Extra costs for importing goods will likely hike prices for us. As businesses are forced to pay higher taxes, some of the extra costs will likely be passed on to consumers. The UK has experienced rampant inflation following the COVID pandemic as global supply chain disruptions and pent-up demand plus war in Ukraine coalesced to create a perfect storm for price rises. This battered households and disproportionately impacted the poorest in our society. There's a risk that firms in hard times won't invest as much and could start laying off staff. So jobs linked to the export sector in particular could suffer some heavy consequences. For comparison, after the crash in 2008, unemployment in the UK rose to its highest rate since 1995 and didn't return to pre-crash levels until 2015. Alongside that, growth in real wages barely rose at all. A subdued workforce, high prices, lack of investment could all lead to a drop in productivity. Extremely low growth could tip the country into a recession. Although economic growth has been high on the agenda for this government, it's not something we've seen much of recently in the UK. And let's not forget, less growth means less money for the government to spend, possibly risking more tax hikes and public spending cuts. But could there be a silver lining in all of this? All eyes will be on lenders and the Bank of England for their views on mortgages and interest rates. But as expectations increase that UK growth will be hit by trade disruption, here and abroad, financial markets are actually bracing for more rate cuts from the Bank of England, potentially 3 more cuts this year. This is all speculative and subject to change, but these shifts in markets could bring lower rates for some mortgage deals. It's impossible to know for sure what this might all mean, but the risks are certainly clear. The decisions made by world leaders will impact me and you. Whether or not this all goes away remains to be seen.